Hey, what's going on, team? Hope that you guys are all having an amazing Wednesday. So we absolutely killed it with shorting BBBY. We did very, very well shorting the overall NASDAQ market. And a lot of people are getting very, very concerned by the market pulling back today. And this just baffles me, right? Because the market has been on a rally. The Nasdaq has gained 20% in the past 3 to 4 weeks. The S&P 500 has gained in the past 2.5 weeks, or really past month and a half, anywhere from around 12.5%. Markets are doing well, and yet the markets pull back. Nothing significant, but just one day, and everyone begins to freak out. I wanted to share a video with you that talks about both the pros and the cons of the current market, and I think it could reassure you as either a new investor or someone that's considering buying more. Both of you, I think what is said in this actual conversation is worthwhile. And again, you guys can just let me know down in the comment section if it's something that you appreciate, and I'd love to upload more videos like this. So first off, quick little update. $8,225 profit short selling BBBY, and it was all caught in today's earlier live stream. So if you guys want to see me lock in profits, then feel free to watch that previous live stream. And it was all caught in the live stream when it began to aggressively sell off. And I missed out. I played it very safe. I locked in profits here, right? I covered my short. It sold off an additional 20 to 18%. I could have doubled it, right? But again, my job's not to be perfect as a trader. My job is just to never be afraid to lock in profit. So let's go ahead and actually hear the CNBC interview. I hope that you guys enjoy, and most importantly, hope that you learned something new.
Safe for buyers at all, and I would say
not being safe.
With the forward PE at 18.3 and the rally that we've seen over the last month and a half, this is probably a fragile environment, and it's not something that I would expect to continue, certainly not at this clip. And I would expect the market to give pieces of this back. I think we got a little bit ahead of ourselves, and it's...
So again, all I take from this is that she's encouraging people or investors to trade lightly, that the market might have gotten ahead of itself of this, 3 to 4 week rally, and that it would be healthy. It would almost be in the best interest of the market for it to pull back a little bit and continue its rally before it becomes so overbought that it just absolutely crashes. That's what I interpreted from what she said.
It's almost like a game of bumper bowling where we're trying to sort of figure out which side of it we're supposed to be on. That said, I'm not as pessimistic as many are for the rest of the year, because I do think that the market is going to react more to inflation coming down and the relaxation in commodity prices than to some of this incoming softening economic data. And the economic data is going to get worse before it gets better. That's how this works. So we need to slow down demand. We need to slow down some of this growth. We're just sitting here hoping to find out that we don't slow it down to a point that turns into a huge contraction. But I really think that that huge contraction risk is more of a 2023 story, not a 2022 story. So as an investor, you want to be present in this market, and I would use down days and minor pullbacks as entry points.
So the thing that I really like about what she said, first off, she's super well spoken, and she talked about that again in the very beginning of, yes, we should expect the market to pull back a little bit. But with that being said, inflation, based off of the last CPI data report, it showed that it pulled back more than expected. The actual reports are showing better than expected. And if this continues, this is at least showing progress, where we're not at least gapping up, especially with commodities, which was a big concern as oil and energy were making new highs, right? Unprecedented highs. So it is very easy to say that energy is becoming more affordable, and on top of that, inflation seems to have peaked based off of recent CPI data reports, which should provide some cooling for the overall market. So even if the market does pull back, do we expect it to sell off as much as it has before? Her only concern was the tightening with the interest rate hikes that the Federal Reserve continues to make, and that's something that no one but them have the ability to control.
Malcolm, it is without a doubt a tricky environment, meaning it's not necessarily conforming to a lot of, the playbooks that might be out there. And by that I mean, if in fact a recession is not here and is not necessarily imminent in the next few months, and it might be a 2023 event or risk, then the market peaked way too early, right? We normally don't have a one-year lead time between the stock market peak and an inflation and a recession showing up. Now, those are a lot of assumptions baked in there, but how would you think about the interaction of what markets have been saying, how the Fed is maneuvering things, and what it's going to mean for the real economy?
Yeah, I think to your point, the split data that we have everywhere on indicators such as strong job growth and retail spending, for example, versus rising interest rates and layoffs and the housing market cooling makes it really tough to look at anything in history and say historically we know that when the market does this, then 12 months later it means it's going to do that.
I think that's a great point to understand. Just hear what he said. That there is not one point in history that has ever been similar to what we are experiencing right now with all the different variables and all the different conditions. With that being said, you can't ever look at history and expect an exact type of response as we've seen before. Inflation is different, our current economy is different, our employment rate is different, everything is different. So I think that was very well said.
Or we know historically that when bond yields do this, then it means that the stock market is going to do that. And so it makes it really tough to point in any direction and say this is absolutely what we're headed for because we've seen this play out before. And so I think to the point that Josh made and then Liz made too, it's not going to be super terrible or super great in either direction in the shorter term. And so it's more a function of making sure that what your expectations are in line with reality, which is, we're not off to the races here. We can't confidently say we've hit peak inflation and it's time to everybody crowd back into the space. But it's also not the time to necessarily get super pessimistic and say, I'm selling out of the S&P completely because I know for a fact it's going back down to 32, 35. And I'll pick it back up from there. So it's really a function of staying disciplined and staying invested, knowing that the market is going to eventually work itself out. In 2023 will probably be a little more clear picture, but we just have to get through this bump with the Fed deciding how much more aggressive to continue to be.
And again, once again, very well spoken. The first thing that he talked about is, again, never in history have we ever experienced anything like this. So it's not a very black and white answer of, hey, things are going to play out exactly like this. He expects in 2023 for things to get better. With that being said, he quickly talked about the idea of, what was it? Let me go ahead and go back to it.
With the Fed deciding how much more aggressive to continue to be.
Josh, just to,
not the time to necessarily get super pessimistic.
I'm sorry, I had a brain fart. But one of the things that he talked about is, because the market could potentially pull back, you shouldn't be super aggressive, but also this isn't a time to completely pull out of your position and not be invested at all. I think piggybacking off of the previous speaker, she said that, again, any pullback that happens moving forward, it's almost an opportunity for the market to potentially peak. And then he touched on the idea of inflation peaking, and this is a comment that a lot of us have been making. And I know some of you guys have been bringing this up where, has inflation actually peaked? Well, if we think back to a couple of months ago, inflation supposedly peaked back then, and then we gapped right back up. Oil prices were still rising there or then, but now we have that same kind of approach where we're showing 1 month of retracement, but it doesn't mean that next month we're going to see that same retracement. So I like how he kind of just, there's that form of disclaimer, because it is a very common thing that we are hearing a lot, that inflation has peaked, but we've only shown 1 month of progression, and we've done that before, and then it showed to have a regression. So something to take into consideration.
Up from there. So it's really a function of staying disciplined and staying invested, knowing that the market is going to eventually work itself out. In 2023 will probably be a little more clear picture, but we just have to get through this bump with the Fed deciding how much more aggressive to continue to be.
Josh, just to look for more apparent paradoxes in this market, or at least mixed signals, we have utilities having made a new high and relative high. So they're kind of leadership somehow within this market that is also seeing an echo bubble in some of the meme stocks and some of the lower quality, heavily shorted names flying. Is there a way to reconcile those things, or just markets do funny stuff?
I think markets do funny stuff is a great answer, and I rely on it all the time in conversation, but the meme stocks are tiny. You're talking about non-S&P 500 stocks. There's really not a lot of institutional money in there. There's like very aggressive trading going on, but there's not enough sponsorship where you could say something thematically is driving big money to be doing trades like that.
And I think that, again, is very well said when it comes down to the meme stocks, right? If you want to take aggressive day trades because of how bullish they are or how overbought they are, and you think that they make a good short position, then great, right? But to compare that to be something, or to compare it to larger companies that are seeing these big shifts, I think that overall correlation is not there, right? None of these companies, BBBY, AMC, GME, Fubo, none of them are under the S&P 500, or none of them have a large enough market cap to actually influence other markets. So I do like trading them from time to time. I view them to be super high risk. I really like to encourage beginners to not trade them because of how risky they are. And I think trading is a lot that has to do with experience. And the more experience that you have, the more that you've been exposed to, and the more conditioned that you are. The more conditioned that you are, hopefully, the more that you can tolerate. And that comes with time, which is why I always try to preach the idea of, take it easy. You don't need to rush into anything. Focus on consistency, focus on risk management. I just don't want you to jump into some of these meme stock plays, go in for a high risk, high reward, lose a ton of money because you have no principles or no risk management, and then you just get discouraged to ever partake in the stock market again. I think it's much more valuable to focus where the value is, and that's in these over or undervalued companies that are, being ready to pull back. I would rather focus on that long term than to encourage people to hodl a stock that, again, is way overvalued based off of recent patterns. Someone commented in the previous video like, Ricky, how can you say that BBBY is a pump and dump? Look at it on the day chart. I mean, it speaks for itself. It shoots up, it drops. It shoots up, it drops. It shoots up, it drops. Shoots up and drops. I mean, I'm not a rocket scientist, but if it shoots up just like it has the previous times and they never hold, what's to come for the other, for what's to come in the near future? It's obviously going to crash. You either lock in profits like a disciplined trader because you know that you are trading a riskier stock, or you get caught holding the bag. There is no other option. I mean, that's literally just it. So you either stay disciplined or you get eaten up alive by the stock market. And I'm here to stay disciplined, and I'm here to encourage you to stay disciplined and manage your risk. I want you to keep some profits in your pocket, and I hope that that's not a bad thing to want for you. So I really do appreciate you guys' time. I hope that you guys enjoyed this video. I thought it would be an interesting topic to quickly cover. Friendly reminder, at techbudsolutions.com, we did just release 2 new articles on the Tesla stock split that's coming up soon, and the Fed minutes report. So if you want to see the Fed FOMC minutes that was released earlier today, and you want a quick little summary, then make sure you head to techbudsolutions.com and read about it. Also, again, if you want to watch me trade live as soon as tomorrow, we're running a $100 discount off of LPP 2.0, and you get to watch me trade live as soon as tomorrow. You get access to our A to Z video lesson library, our daily group chat, and yes, you get access to our Techbuds HQ, which are 7,000 square foot facility, 15 offices located in Chandler, Arizona. It's all inclusive. It's a one-time payment, lifetime access, and right now it's $100 off, and that's that second link down below. If you have any questions about what we talked about today, feel free to send me a direct message via Discord, and that's that first link down below. I really do appreciate you guys' time. I hope that it earned your thumbs up. Please consider subscribing, and like always, let's make sure that we end the year on a green note. Take it easy, team.